Hey, Mark, it's good to see you. We have some big news for everybody today. Secure Act 2.0 finally passes, and this is going to bring about a lot of changes to retirement account rules. So we're breaking down the big takeaways, including some unique opportunities and some changes for tax planning. So one of the biggest changes, Mark, that we wanted to talk about right off the top is this new RMD age table. What do we need to know?
Well, Erin, thank you so much, and it's great to see you again. Well, it's interesting because we've had Secure Act 2.0 or 1.0, 2.0. They keep changing things,
Right.
and this is part of our life now. But one of the big things is they push the required minimum distribution age. It used to be 70 and a half for everyone. Then it became 72, and now they've got different phase outs. So if you were born between 1959 and 1951 and 1959, you now have to wait, or you can wait till age 73. 1960 or later is now 75. And the reason they're doing this is two things. One is obviously they're allowing the money to grow more, so they're going to get more tax revenue. The second thing, though, is we have longer life expectancies. People are living longer. So obviously they're moving those tables out to accommodate that.
Okay. And then staying on the topic of RMDs, those penalties for missed payments have changed. What do we need to know here?
Yeah, so this is good news if you happen to not take the required minimum distribution, because it used to be a very stiff penalty. I mean, it was 50%. So,
Wow.
for example, if I had a $10,000 RMD, I mean, I had to pay a $5,000 penalty, and I had to take the 10,000 out and pay ordinary income tax on it. So now the penalty has been reduced to half, 25%, still pretty stiff. But if I shore the account up fast enough, it now only becomes a 10% tax penalty.
Okay. I want to get back, though, to those delayed RMDs because you mentioned this too. This is going to lead to a larger account balance at death. And Congress stripped the lifetime stretch IRA rule. So now almost all beneficiaries must take out all that money in a 10-year period. And that is quite the tax burden.
Yeah, I mean, if you really think about it, a lot of the people that we speak to, we kind of ask them, we say, what's the biggest expense you're going to pay for in retirement? And a lot of times, obviously, you get health care. But I go, well, wait a minute, let's look at your 401k, or IRA.
Hmm.
What's the biggest expense you have in that account? And most people will say, well, it's the management fees. And I say, no, it's actually the tax.
Right, right.
And a lot of our clients have been really good savers. They dotted the I's, they crossed the T's, they did everything correct. And now they have this large sum of money, and many of them don't need it. So when they take it out, they're now having to pay more taxes. They have no deductions. They're being thrown into higher tax brackets. It's affecting how much Social Security taxation they're getting, as well as a lot of them are paying surcharges on their Medicare Part B premiums. And then you're right, along with that, it used to be when you died and you had a child as a beneficiary, they could do a stretch or a continual IRA, pay a little bit of tax, stretch those payments out over their lifetime. But now the IRS says, nope, can't do that. You got to take it out and pay all the taxes within 10 years of the decedent's death, and which ultimately is just creating more tax revenue for the
Right,
government. So all
right.
these rules, if you really look at them, it's not benefiting us so much as it is
Right.
benefiting the government.
Right, exactly. You mentioned, though, some strategies that people should maybe consider today to prepare for these eventualities, to lessen their tax burden for themselves and for their beneficiaries.
Well, yeah, and everybody's situation is different, but I think being open to a conversation, opening that door. So obviously, you can look at Roth conversions
Mhm.
as an idea, but this requires some specific tax planning and how you structure that. We've actually created a program we call IRA Rescue, and IRA Rescue actually allows us to accelerate that tax planning because most of our clients that come in have most of their money in a tax deferred bucket. When you look at their tax free bucket, there's almost nothing there. So, what we're really trying to do is pay taxes when taxes are on sale, reduce that required minimum distribution exposure because that's forced taxation. So, it's not like we're going to get around the taxes, but we're going to pay taxes on our terms and not the government's terms.
Right. You bring up a really good point. We are living right now at a historically low tax rate. So that is a very important consideration. Mark, if somebody would like to talk through these changes that Secure Act 2.0 brought, or maybe some of these strategies that you're mentioning, what's the best way to reach you?
Well, the best way is just reach out. Call the office 303-681-0113. You can also email me, mark@mgswealth.com, or go to our website, check it out. It's mcgregorwealth.com. And either way, get in touch with us. We can set up an appointment and we can really dive into some of these tax planning opportunities.
That's great. Mark, thank you very much.
All right. Well, thank you, Erin, and have a wonderful day.
You too.
All right.